We will now take our first question from Ron Busso from Reuters. Please go ahead.
Hi, Jessica. How are you? Hope all is well. Two questions. With the lower net debt, could you give us any more guidance on buybacks? When do you think they'll resume? Is it still 2022? And about on LNG front, on Qatar, I'd like to hear your thoughts on what you expect to happen with your contract, the Qatar Gas 4, following QP's decision last month. And also whether there's any update on the expansion and Shell's plans to take part in the expansion. Thank you.
Good morning, Ron. Good morning, everyone, and welcome to the call. Thank you for joining. On your first question in terms of the progress against net debt, indeed, a very strong quarter for us in terms of cash generation, some $12.7 billion excluding working capital and over $8 billion with working capital. Free cash flow, some $7.5 billion generated for the quarter, which contributed to the reduction in net debt of some $4 billion. So we're well on track in terms of reaching our net debt milestone of $65 billion. Pleased with the pace. We don't have a specific timeline associated with reaching that target. I think, the relatively improved macro, it's still weak in some places, but clearly on the right path in terms of overall improvement. And importantly, the strength of our portfolio and operations showing what we can generate in this macro gives me confidence that this pace is a good one, and hopefully we can continue it for the upcoming quarters. We're not going to provide a specific timeline, but hopefully sooner rather than later in terms of achieving the $65 billion. In terms of Qatar, I don't have anything specific to report at this moment, and I can check with the teams if there's anything of note that's worth providing to you, Ron. And of course, on the expansion, we look at all opportunities in terms of trying to source the most competitive LNG for our portfolio going forward, and this will be considered amongst other options for us. Thank you, Ron. Next question.
We will now move to our next question from Sarah McFarlane from the Wall Street Journal. Please go ahead.
Morning, Jessica. I just wanted to ask about your outlook for demand and whether we'll see a full recovery to pre-pandemic levels for oil or gas this year. And secondly, I wondered whether you might revise your divestment target higher. You obviously mentioned on the call now that you've already met the $4 billion target for this year. Is there a chance that you will lift that target? Thank you.
Thank you for the question. In terms of demand and the macroeconomic environment, I would say that it's really a mixed bag. It depends on which product, which sector, which country that you're referring to. So in places like China, demand across the board has been strong, whether you're looking at LNG imports, if you're looking at what's happening in our retail business in terms of oil demand. But in other parts of the world and other parts of the sector, softer outcomes we're seeing. So in the first quarter, in our marketing business, you'll see that the volumes were softer than they were last year, reflecting the impact of the pandemic, particularly in Europe, but also things like the freeze in the U.S. also having an impact on our downstream business. So I'd say it is a genuine mixed bag. Obviously, aviation hasn't picked up to the levels that they were pre-pandemic, and we believe that'll take some time yet to achieve. So very different realities in different parts of the economy and different parts of the world. I would say overall, though, we believe the trend is going in the right direction, and we're certainly in I think, a more clear place, a relatively less uncertain place than we were in 2020, and are hopeful that the underlying trends that we're seeing in some of the countries continue. But we have to wait and see. As we know, the pandemic is still having a real effect in places like India and Brazil. And we're just emerging from that effect, and the demand piece of that will take some time to pick up. But overall, we believe the trends are moving in the right direction. In terms of the dividend target, very pleased with what we've achieved in the first quarter. The environment for divestments, I think, are stronger than they were certainly in 2020, as I just referenced. I think the reduced uncertainty in the economy is being felt certainly in the oil and gas sector, and the macro environment for oil and gas prices have trended up for the last couple of quarters. That's certainly supporting investor appetite to buy assets, and we're feeling that. We've been able to move more quickly on a couple of assets than we had anticipated. So I'm optimistic, but we don't feel there's a need to update our targets at this point in time. Thank you. Next question.
We'll now take our next question from Laura Hurst from Bloomberg. Please go ahead.
Hi, good morning, Jessica. Two questions from me. My first is, was there anything unusual in the debt reduction this quarter? Basically, do you expect you can continue to reduce the debt at a similar pace? And my second is on gas trading. Shell is one of the biggest gas trading, or rather has big gas trading operations in the US, and you're a very big LNG trader. So why didn't you capture that in the first quarter as some of your competitors did? Thanks.
Great. Thank you, Laura. In terms of the net debt reduction and what's driving it, and were there some one-off benefits, I'd say for the most part this speaks to the fundamentals of our business, the strength of our portfolio, the strength of our operations, which is generating the cash of, as I said, some 12.7 billion pre working capital. And that's consistent with how we've been delivering, frankly, for the last couple of years. And in all macro environments, I think you've seen the strength of our cash generation. So I think that the net debt reduction is a reflection of the fundamentals of this business, with some help from the macro. So oil prices certainly helped, going above 60. We saw some improvement in the margin environment in refining and certainly in chemicals. They're still relatively low in refining, I'll point out. So while better than Q4, they're still relatively low from a kind of historical perspective. So it's not that we're operating in an overall strong macro environment, as I just mentioned earlier, a very mixed bag. In terms of the cash generation and what's, if there were anything kind of positively supporting it that's worthy of note, I would say that the cost of sales adjustment does positively affect the numbers for the quarter. We had some benefit from variation margin in the cash, as well as some $600 million and somewhat lighter from a tax perspective. So if you were to normalize all of that, I'd say in this mixed macro environment, we have underlying cash generation of some $10 to $11 billion. That level of cash generation should continue to support net debt reduction over time. There's nothing else really of note in the numbers in terms of what would be different from the next quarter. Working capital works itself out over time, so that's not something I think to get too caught up in the quarter. So the underlying cash generation, I think, is what's driving what we delivered today and what I expect we can continue to do in the coming quarters, assuming the macro environment's where it needs to be. In terms of gas trading, indeed, our numbers are strong without a huge contribution from our trading business. Our trading business capability supports all of our businesses. It supports oil products, it supports LNG, it supports gas and power. There are different realities across that portfolio. There was some strong trading performance in pieces of the portfolio. But on the gas side, it was lighter than it has been, certainly in 2020, where we saw some very strong delivery. I'd say it's a mixture of operational and kind of portfolio realities in the quarter. There were some important movements in the market in the quarter, but they were relatively short-lived and with few transactions taking place at those levels. I'm referring to the JKM spike in January. And in North America, we did see some benefit on the gas trading side. But overall, the Texas freeze event had a number of mixed effects, and as we've indicated, a net $200 million impact on our business, primarily driven by the impact on our assets. So, sorry, Laura, a number of different pieces in that description. I think what I would take away from it is that the cash generation of the business was really based on the operations of the business, with less support from trading than we've seen in the past. Next question.
We'll now take our next question from Anjali Raval from Financial Times. Please go ahead.
Hi, Jessica. I just wanted to ask my first question on the dividend. There have been 2 increases since October. Look, I know there's this annual target, but is this it for 2021, or would you not rule out further increase given the pressure Shell is under to return cash to shareholders? And on my second question is just sort of looking ahead to AGM season. Obviously, there are some investors and there's some activist groups who just don't believe you guys are going far enough. I mean, are we now at a point where Shell has just reached the conclusion that some people are just not going to be placated, and so companies should just do as it pleases rather than going out of its way on messaging or engagement or even corporate strategy? You've put out your strategy, and is that kind of it? What is your? I'd just like to hear more about your approach as to sort of how you will handle some backlash that you're probably likely to face going into next month.
Great. Thank you, Anjali, for the questions. Starting with the dividend question, indeed, we increased dividend per share by 4% in the first quarter, as we had announced previously, and that builds off of the increase that we had done coming out of the third quarter as well. We're looking to do this on an annual basis, so this would be the increase for 2021. We're not anticipating a further dividend per share increase in the year. We're trying to be clear in terms of our minimum expectation on shareholder distribution growth in a year, and as we've done historically, we've done that in the first quarter, and that's what this reflects. That's why we did it in the first quarter, to provide that kind of consistent frame and be clear so the market knows what to expect from us. But of course, once we reach the $65 billion milestone, we're then looking to distribute a total of 20 to 30% of our CFFO, and that will take the form of share buybacks or further dividend growth, and we're looking forward to that moment in time. In terms of the AGM and the energy transition piece of the what's on the agenda for the AGM, it's an important year for us with respect to the AGM and the way that we're engaging with our shareholders. We released in April the Energy Transition Strategy Report, which lays out in totality what Shell is looking to achieve with respect to the energy transition, what our ambitions are, how we're going to judge success, and how it's fundamentally going to touch every part of Shell's business. We thought it was important to put it all in one place for all of our stakeholders, and importantly, our shareholders. This is, if not one of the most important issues for us strategically, and it is important that people understand what we're trying to achieve, hopefully believe in and back what we're trying to achieve, and in particular from a shareholder perspective. As you mentioned, as expected, across society, there'll be different perspectives on what Shell's doing, if we're moving fast enough, if we're ambitious enough. I personally believe it is one of the most ambitious plans out there for a company and certainly for our sector, both in terms of the quantum of what we're trying to achieve as well as the scope that we're trying to achieve. As I said, every part of Shell is being touched by the energy transition, and we're doing all that we can across the company to deliver new products, new services for our customers so that we can decarbonize the energy system. And it's really important that all stakeholders, but in particular our shareholders, understand that. We engage a lot externally. There can be negative feedback on what we're trying to do. I believe with the parties that are very involved on this issue and are thought leaders on this issue, we have important support. And I would point to Adam Matthews of the Church of England recently released a piece describing his view of our energy transition strategy and why he is advocating that it gets supported and why the Follow This resolution should not be supported, and that's the company's recommendation as well. But it's always good to have someone outside the company make your case, and I think he makes it very eloquently that what we're trying to achieve in scale and scope is ambitious, and it is clear, and is, I think, meeting the needs of what society needs from Shell in terms of delivering on the energy transition. Thank you. Next question.
We'll now move to our next question from Emily Gosden from The Times. Please go ahead.
Morning. Thanks very much, Jessica. I wanted to ask about the oil price outlook insofar as the huge impairments that you booked last year, I think were mainly based on changes to the short-term oil price outlook. Last summer, you gave us figures of, I think, Brent at $40 this year and $50 next year. Given how the market is looking, has those numbers been updated? And could you be in a position to potentially write back some of those write-downs that you took? And secondly, I just wanted to ask, when your shares are still down about, I think, 40% since the start of last year, and I wonder what you think that primarily reflects, whether that's about kind of the lower return still, or whether that's about kind of wider strategic questions. Thank you.
Thanks, Emily. I must admit the sound here is not perfect for me, and so your second question, my team is typing it up for me. Share price, what does that reflect? I'm sorry, Emily, could you repeat that second question?
Sure, sorry. It was just that with shares still down by about, I think, 40% since the start of last year, I was asking whether you thought that primarily reflected just kind of focus on lower distributions, or whether that reflects actually kind of more fundamental questions about your strategy.
Great. Okay. Good. Thank you. I think I now understand both of those questions. On the first question, in terms of the price outlook, indeed, last year we were looking at prices of some $40 a barrel, which is largely of what played out. And so we had initial set of impairments we did relating primarily to the short term that was done first quarter. In the second quarter, we then had further impairments. Those were largely driven by a change in long-term prices. And so the bulk of it really was a changed view over the next 10, 20 years that was driving it. And I would say there's nothing at this moment in time that we're changing in terms of our fundamental outlook for the next 10 to 20 years. I try not to get overly preoccupied with the oil price from in terms of changing our fundamental view, because they are quite volatile, as we've all seen in the last 2 years. And we're very hesitant to ever kind of write back values, which is typical practice. So there's not enough change and fundamental change in our views to really change our long-term outlook on prices, and therefore I don't see any change from a valuation perspective on the balance sheet. On your second question in terms of share price, great question. In terms of the share price, I could also ask your perspective, but perhaps more on a one-to-one perspective rather than this setting. I think the sector is in transition as much as the energy system is in transition, and it has been important over the last year for us to be clear what our strategy is, how we're going to navigate the energy transition, how we're going to create value in the energy transition. And that's what I believe we accomplished in our strategy day in terms of laying out how we're going to manage and make sure Shell remains relevant and creating value for the decades to come. I think the markets are still learning and figuring out how to value each of these strategies differently, and to think about where value creation will happen. The dividend cut last year certainly is not helpful from a share price perspective, and it was an incredibly difficult decision for us, and one I hope not to be a part of again, and I don't expect there'll be circumstances that would cause that to happen again. That certainly plays a part in terms of the impact on the share price over the last year. I believe that the fundamentals of this company are very strong. I think we have the right strategy, the right portfolio, and the quality of our operations are all coming through. And you see that in the cash flow that we're generating of some $12.7 billion. We've been the highest cash generator in our sector for 4 years. So I think the fundamentals of this company are strong. We're strengthening our balance sheet. We're delivering substantial amounts of cash. And we have a forward-thinking, competitive strategy that we're executing against. And I sincerely hope that those pieces come together and get reflected in our share price in the near future. Thank you. Next question, please.
We will now take our next question from Edwin van der Schoot from Telegraph. Please go ahead.
Yes, good morning, Jessica. I was wondering if you could elaborate a little bit about jet fuel, because obviously these are good results, but I guess that's the part of the market that's still lagging behind most. Can you give us some numbers on and maybe an outlook on sales you've done, production, and maybe in the long term, where do you see this market going? Thanks.
Thank you, Edwin. Indeed, jet fuel demand remains incredibly depressed. International travel isn't picking up. You're seeing some increases in domestic travel in places like the US, where some of the numbers have increased materially over the last couple of quarters. But globally, as I think is clear to most people on this call, people moving between countries and even within countries remains quite limited. And so we've seen reductions of some 70% on jet fuel demand over the last year. And the expectation is it will take some time for that to recover. And because of all of the constraints that are put on travel, I think the travel sector themselves and the aviation sector themselves have indicated it's going to likely take a couple of years before we get back to pre-pandemic levels. So I think that's going to be one that's going to take some time to recover before perhaps other parts of the economy recovers post the pandemic. I think maybe what I'll just say, another part of the jet story, of course, is what we're doing in sustainable aviation fuel, which is the future of jet fuel, and a number of important initiatives or milestones achieved in the first quarter in terms of investing in LanzaJet, and we're built and working with Rolls-Royce on the use of sustainable aviation fuel. So we're pulling a number of levers in terms of reshaping and driving the energy transition with respect to aviation fuel. That's probably one of the more exciting pieces of what's happening in our portfolio with respect to the aviation sector. Thank you. Next question,
We will now
please.
move to our next question from John Mainwaring from Energy Intelligence. Please go ahead.
Hello, Jessica, and thanks for taking my questions. I've got two of them. I want to come back to the questions earlier about shareholder distributions or increased shareholder distributions, and when you will meet this $65 billion net debt target. You seem to be saying earlier that the level of cash flow, you would expect that to continue if the general operating environment and business environment stays as it is. But then you were saying that you're not anticipating increased dividends later this year. So what does that mean? Does that mean you don't expect any, you don't expect the $65 billion target to be reached this year, or does that just mean that if you do increased shareholder distributions later this year, that would come in the form of share buybacks? And then my second question is, investors at the moment have a choice. If they want to get involved in investing in energy companies, they can go for the dividend and yield by investing in US companies, some of the majors, or if they want to get involved in the future and invest in the energy transition, they can invest in a pure play business that isn't saddled with a lot of debt. So I'd like to have a better idea of what Shell's investment case is.
Great.
Thank you.
John, thank you. Thank you for those questions. And I appreciate the first question because I can see how some of my initial comments would benefit from some further clarification. When I said I didn't anticipate a dividend increase this year, what I was speaking to was our progressive dividend policy, where we're looking to do 4% a year. And so I wanted to be clear that 4% that we speak to on the DPS growth is what we've achieved in the first quarter. In addition to that, we've got a further ambition, which is to increase shareholder distributions once we've reached the $65 billion milestone. That could happen this year, or it may not happen this year. And I wasn't trying to signal one way or another in terms of expectations when I made that statement on the dividend. I was trying to clarify the 4% dividend per share progressive dividend policy and the timing of that. In terms of the net debt, as I mentioned earlier, we don't have a specific timeline in mind. It is very macro dependent and obviously operationally dependent, assuming our operation levels are what they are today, which are very strong across our businesses. You see the level of cash generation that we achieve in a quarter, and as I indicated, the majority of that is sustainable. If you were to completely make it clean for the quarter, I would say the number of $10 to $11 billion is the clean underlying without any benefit of things like derivatives supporting the cash flows. So substantial amount of cash flows. We're very disciplined on the capital stewardship and therefore clear in terms of what you can expect on the CapEx. So all the pieces of the puzzle are there. It's just a question of how the macro will play out, and we do not want to kind of anticipate that or incorrectly set expectations one way or the other. As I said, we're looking forward to getting to that milestone as sooner rather than later, and I certainly hope it's in the near term. And when we do, it will be a mix of share buybacks and potentially dividend increases. I will say that there is a lot of energy around share buybacks. They're flexible, and we also want to keep connected to the dividend per share growth and to offset that with share buybacks as well. So there's a lot of focus on share buybacks. In terms of the investment case for Shell, as you point out, there's different options for shareholders, even within the sector, let alone with other sectors. So why Shell and versus some other options? One, I'd looked at I'd start with the strength of the business today. You're buying a company, you're buying an asset, an equity in a company today. What you're seeing for the last 4 quarters is a company that generates more cash than anyone else in our sector, demonstrating the strength, I believe, of our strategy and our portfolio and our operational capability. We generate that cash by the strength of our individual businesses, but importantly by the strength of the integration across those businesses, supported by our trading capability, where we have unique positions in the energy system, whether it be from our LNG business, where we have an unmatched network of positions and capability across the globe that continues to generate significant value for us. We've got a leadership position in deep water in our upstream business. Again, the highest margin barrels in the sector that we're able to benefit from. And then in our oil products business, our marketing business, again, unmatched. Some 46,000 retail stations around the world, the highest value brand in the sector, once again, generating significant earnings and cash quarter in, quarter out. And then importantly, we've got a very future-oriented strategy. So if you want a company that's going to be relevant in creating value, we've got that, leveraging the strengths of the business that we are today, leveraging the assets that we have today, but importantly, working from the customer back. And what are the energy products and services that the world needs to decarbonize? We've got those relationships, we've got that market presence. We're going to leverage that with our asset capability and our technical capability and our business models to help drive that energy transition to create value in the future. So our investment case is that. It is our strategy, it's our portfolio, matched to, I believe, a very compelling investment case around shareholder distributions, which is 4% every year, subject to board approval, with upside associated with the growth in cash flows, which again, I hope to see in the near future. So I think you have to think of an investment case in that integrated way. I think Shell's is unique, and we're uniquely positioned to create value through this energy transition. Thank you. Next question, please.
We'll now take our next question from Robert Perkins from Platts. Please go ahead.
Hi, Jessica. Couple of questions on the upstream and production volumes. I know you don't generally give sort of broader production targets as such, but I mean, just looking at the near-term guidance, I note that you're guiding towards lower volumes in the second quarter, down from the first quarter. And I just wondering what the main moving parts for that might be. I'm thinking around presumably asset sales, but on the flip side, you've got presumably a lot of barrels coming back on the OPEC Plus side, which might feed into the idea of there being an improvement in volumes. And then further out, again, anything you can say about in terms of when you may return to 2019 levels? I don't believe Shell's flagged any peak in upstream volumes as some of your other peers have, but any color around when you may or may not return to pre-pandemic levels would be fantastic.
Great. Thank you, Robert. The production outlook in the near term is relatively straightforward. You've touched on some of it, which is the impact of divestments is certainly coming through. But importantly, we're doing maintenance in the next quarter. It's typically a maintenance quarter for us, the second quarter. But importantly, we're also trying to do some makeup from last year because of the impact on the pandemic. We weren't necessarily able in all of our assets to do the maintenance that we had intended to do. So that's also coming through in the quarter. And there's still some OPEC impacts, as you referenced as well. So there's nothing else kind of in that. I think it's a relatively straightforward story in the near term. In the long term, what we've indicated is between now and 2030, some 1% to 2% reduction in production over time. Our focus is really on maximizing value from the barrels that we have, and we continue to push this value over volume story. And we're continuing to fine-tune our portfolio, bring new assets into the portfolio, develop new assets in the portfolio with even lower development costs, lower operating costs, and generate more margin per barrel so that the value is dependent on the quality of our portfolio and the quality of our operations versus the total volume of barrels that we produce. So that's our strategy, and that's what we'll be playing out over the next 10 years. Next question, please.
We will now move to our next question from August Graham from PA Media. Please go ahead.
Morning. I was just wondering if you could provide a little bit of colour around the stuff that happened in Texas. Kind of what struggles did your staff face there, and what kind of exceptional things, measures did they have to take to kind of keep running at that time?
Sure. So the Texas weather event, I expect most of you know that pretty significant freeze occurred in Texas over a good part of the state, and that disrupted the entire energy system from the gas pipelines delivering gas to power plants, to wind turbines, to transmission towers, to the power plants themselves, as well as upstream production. So the entire energy system was not designed for freezing temperatures that lasted for some 5-6 days. And so that affected the entire system. For Shell in particular, our assets that we operate were impacted in places like the Permian, and also our chemical and refining assets in Texas were also impacted by the freeze. And the $200 million that we reference is mostly in relation, if not entirely in relation to the impact on Shell's operations. So a pretty significant effect also on our employees. People are all working from home, but people lost power and heat in their homes. So it's some pretty extraordinary efforts taken by our teams in Texas to support one another, but importantly to continue to flow energy and gas and power to customers and keep the system running. So a lot of extraordinary efforts to manage what the system was not designed for. Thank you. Next question, please.
Just as a reminder, it is *1 to ask a question. We'll take our next question from Alistair Thomas from Energy Voice. Please go ahead.
Good morning, Jessica. Thank you for taking my questions. It was revealed last month the UK government's been considering a ban on new North Sea exploration, similar to what's being done in Denmark. I was just wondering, do you think that an exploration ban would be the right decision should it come to pass? And if I could be cheeky and ask a second question, the UK government also last month signed a £16 billion North Sea transition deal to be delivered by 2030 to help the sector diversify out of oil and gas. And it's since become clear that the majority of that money is expected to come from the industry itself rather than a more joint approach with government. So how easy or not do you think it's going to be to get operators such as yourselves to stump up that kind of money? And is it right that they should be the ones that have to do so? Thank you.
Great. Thank you, Alistair. So in terms of the UK exploration ban, I'll say that I'm not familiar with it. So I can't speak to its specifics, but maybe I'll just make a few comments on the principles. The transition of the energy system is a complex one with a number of trade-offs. I think we need to focus a lot on the demand side and to understand how energy will be provided to meet that demand. So in the UK, for instance, some 90% of homes are heated by natural gas. And so unless the country finds a new way of heating homes and puts that in place relatively quickly, whether it be through electrification or perhaps some kind of hydrogen solution, whatever it may be, that will take time. And in the meantime, you need to ensure security of supply to ensure that people can continue to heat their homes, their offices, hospitals, etc. So I think understanding how the system will transition is really important before you start deciding whether some oil and gas assets are worthy or not, and because that gas will need to come from somewhere. And is it better to come from the UK? Does it have a better CO2 profile than perhaps the alternatives? And of course, there's the economic impact in terms of the jobs that are created, the investments that are made associated with that investment. And so if you're going to use that gas in your country, I think that holistic understanding is needed. And to recognize that fundamentally what's going to change the energy system is what customers and demand, how it shifts over time. And if it shifts to electrification, if it shifts to hydrogen or other solutions. And Shell wants to be there side by side with society, making all of those options possible, and hopefully finding the best one for the planet, best one for society, and economically as well. In terms of, sorry, I got caught up in that question. Okay, in terms of the transition, the North Sea transition plan. So we're very pleased with what the UK government's trying to achieve and being proactive in terms of shaping the transition for the sector and thinking through all of the various implications, some of which I've referenced here. You know, how do you transition the workforce so that you can have high quality jobs for people as you move from an oil and gas sector to a power sector or other solutions in terms of the energy transition. And in terms of the funding, it's an important one. I think all sectors of society are going to have to contribute. Not one sector is going to be able to fund the entire energy transition. The wealth that's going to be required to change an energy system we've created over the last 130 years. The oil and gas sector would in totality would struggle, and certainly even one or two companies for a country would be insufficient. But we're all going to have to contribute our expertise, our energy, our passion, and our resources to do what the planet needs. And again, Shell is looking forward to working with the UK government, is pleased with what they're trying to do with this transition strategy, and to play our part going forward. I think that was our last question. So thank you everyone for joining today. I hope this has given you insights into our performance in the first quarter of 2021. We will host our annual general meeting on May 18th. Have a great rest of the week, and please stay safe, everyone.
This concludes the session. Thank you for your participation. You may now leave the call.